All right, let's jump straight into this explainer. The traditional discretionary trust, it's facing an absolute earthquake in compliance. We've got a brand new 30% minimum tax on the horizon. But the government is offering what looks like a 3-year escape hatch. So today we're going to break down the exact mechanics of how to restructure and, more importantly, whether you actually should. To really grasp how much this upcoming 30% trust tax will actually cost you, we've got to step away from abstract policy. Let's look at a concrete example to see what this structural shift means in real hard dollars.
Picture a family business. They're operating through a standard discretionary trust. And this financial year, they generate a total taxable income of, let's say, $300,000. Now, the primary owner takes a totally reasonable salary of $100,000. Once you subtract that, you're left with $200,000 of trust income just sitting on the table, ready to be distributed out. So that remaining $200,000 gets split 4 ways. That's $50,000 each, going straight to lower-income adult family members. Historically, this has been a brilliantly efficient way to manage a family's overall tax burden. It just made sense. But fast forward with me to July 2028. Bam! A 30% tax floor hits. The trustee pays the tax up front, and beneficiaries get non-refundable credits. What does that mean for those lower-income family members? Well, they lose out entirely. Because the credits are non-refundable, that historical tax efficiency literally evaporates overnight.
Recognizing just how massive this shift is, the government is rolling out something called rollover relief. Now, because discretionary trusts don't actually have fixed ownership by design, they had to build this bespoke provision. It's essentially an escape hatch, allowing families to transition assets out of a discretionary trust without triggering an immediate capital gains tax bill.
Now, what's incredibly interesting here is the timeline. A lot of folks are just mentally merging all these dates into one giant panic deadline, but let's untangle it. Right now, we're in the consultation stage. The rollover window actually opens in July 2027, but the tax doesn't hit until July 2028. And then the window officially slams shut in June 2030. This specific timeline creates a really strategic anomaly. We're calling it the golden overlap here. From July 2027 to June 2028, families have a 1-year overlap where they can restructure and transition assets out, utilizing that rollover relief before the new 30% tax even applies. But hey, you've got to read the fine print. This relief, it's a deferral. It is not an exemption. The embedded capital gain moves right along with your asset. So if you move that asset into a company, for example, you're going to permanently lose access to the 50% CGT discount. You might literally just be making the tax can a whole lot heavier before you kick it down the road. And while we're talking about costs, we cannot forget about state stamp duty. You see, this rollover relief is strictly federal. That means state transfer duty on the market value of your assets still acts as a very real and often very expensive toll booth. There's no getting around that. So let's say you decide to take the escape hatch. You essentially have to choose between 2 main structures, a company or a fixed trust. Neither one is perfect, by the way. Understanding the trade-offs between them is where the actual heavy lifting of tax planning comes in. Let's look at the company route first. Moving to a company solves the 30% problem cleanly. Bam, fixed. But the sacrifices are huge. You permanently lose discretionary income splitting. You kiss the 50% CGT discount goodbye. Plus, extracting profits down the line creates all sorts of complex loan traps like Division 7A. Sometimes liquidating the whole thing becomes the only clean exit. Alternatively, you could go with a fixed trust. This avoids some of those nasty corporate tax traps, but you lock in the specific entitlements of the beneficiaries. That means you are sacrificing the exact flexibility that made discretionary trusts so appealing for asset protection and succession planning in the first place. You're basically trading agility for tax certainty. Okay, so given all these immense, headache-inducing structural trade-offs, what if there's a simpler way? Before you jump headfirst into a massive, complex restructure, there is a totally overlooked, actually quite boring workaround that doesn't require dismantling your family trust at all. We call it the wages workaround. Think about it. If those lower-income family members actually work in the family business, just shift your strategy. Pay them ordinary, commercially justifiable employee wages throughout the year. Because they're getting paid normal salaries, that money completely bypasses the new minimum trust tax. It completely transforms the situation. The government framed all of this as shutting down some massive tax loophole, but And as we were certain all along, it's really just being replaced by a boring new compliance requirement. You're basically just putting family on the payroll and paying superannuation rather than relying on a magic year-end trust resolution.
So, with this golden window approaching fast, your natural instinct might be to panic, pick up the phone, call your accountant, and start transferring assets tomorrow. Hold on a second. Let's talk about exactly why you shouldn't rush into this escape hatch just yet.
Remember, we are firmly still in the consultation stage. So many structurally vital details are completely up in the air. How do we handle existing unpaid present entitlements, or UPEs, to bucket companies? What happens to excess franking credits trapped inside a trust? The exact scope of the rollover isn't finalized in law yet. Making a move before the rules are set is literally flying blind.
The absolute smartest move you can make right now is all about preparation. Model your numbers today with your advisor. Run the scenarios, look at your specific assets, calculate those stamp duty costs, and review your long-term succession goals. But please, hold off on actually pulling the trigger and signing transfer documents until the final legislation is completely settled. Before you just rush for the exit, you've got to ask yourself one crucial question. Does the cost of this escape hatch actually outweigh the penalty of just staying put? To know more about these kind of topics, subscribe to WealthLogic AU. We're going to keep bringing you the structured analysis you need to make the right call.